Today in this video, we're going to talk about how to calculate your income when you're self-employed. We're also going to talk about how to calculate your income for you people who are W-2, but we're especially going to talk about what numbers you need to be looking at when you are self-employed and you're trying to calculate your income to try to get a mortgage. Check it out. Hi, I'm Rhonda Burgess, and I'm a real estate broker and mortgage underwriter here in Nashville, Tennessee, and my firm is Southern Living Realty Partners. Okay, first of all, we're going to talk about how to calculate your income when you're self-employed, and we're going to take a look at exactly what you need. First, let me touch on my W-2 people. You know, when you're W-2, they're just going to take your 2 years worth of, your W-2s. They're going to take, they want to see a month's worth of paycheck stubs. And then they're just going to average those together for the last 2 years. So if you made $50,000 each year, then $50,000 is going to be your income. And then they're going to divide that by 12. That's what's going to be your monthly income when you are W-2'd. Secondly, for you W-2 people, so for you part-time people who are W-2 or salary, you're going to need 2 years on that job, and they're going to verify that you have 2 years on that job. They're going to call and do a verification of employment, just like they do on your full-time job, but you're going to need to be on that job for 2 years. And they're going to, again, average out the money that you've made over those past 2 years. Now, for my self-employed people, it gets a lot deeper because you're in a previous video that I've done, and I'll link it below and at the top here, you're going to need to bite the bullet for 2 years on your self-employment and not write everything off. That's the only way you're going to be able to qualify for a loan. And when I say qualify for a loan, I'm talking about with a qualifying mortgage. That means it's your standard government issued loans, like your FHA, your Fannie Mae's, your Freddie Mac's, your VA, your USDA loans. Those are qualifying mortgages, okay? And so those are the ones that are going to have the interest rates that are in the 3% range, okay? I'm going to do another video about non-qualifying mortgages, like how you can use bank statements to qualify to buy a house. The one thing you need to remember about your bank statement mortgages are they're going to require more money down, and the interest rate is going to be higher. They're not your standard loan. These loans, they can't be packaged with your Fannie Mae's and your Freddie Mac loans and sold on the market. So they have different pricing and different criteria, but there are alternatives. But let me get back to this on calculating your income when you're self-employed. First of all, when you're self-employed, they're going to want to see your 2 years worth of tax returns when you're going for a government or a qualifying mortgage, okay? They want to see on your 1040 form, they want to see line 11, your adjusted gross income. This is what's important, your adjusted gross income, okay? So like for our self-employed people, you know, you're going to be up here where they say put in your wages, you know, from your W-2s and, you know, paycheck stubs and stuff like that. For the self-employed, they want to see what are you taking off on Schedule 1. Your Schedule 1 is your additional income and adjustments to income. This is where your Schedule C is going to come into play, because they're going to want to see what you have on line 3, your business income or loss, and then it says attached Schedule C. This is where your Schedule 1, you get the numbers for your Schedule 1 from your Schedule C. So if you're showing a loss, on your Schedule 1, which is coming from your Schedule C, where you're saying, hey, my business, you know, I may have had $80,000 in gross receipts, in gross revenue. But once I deducted all my deductions, like even my mileage and depreciation and everything like this, Because you are self-employed, you wrote it all off. So now you're at a loss. That's cool as far as taxes is concerned. You won't pay no taxes. You may even get, if you paid in any money, you may get that money back. But it's not going to help you when it comes to buying a house. So what you need to do, and this is my opinion, this is how I did it to get my house when I was totally self-employed, was at first I stopped and looked at the cost of the house that I was looking at, that I wanted, in the neighborhood that I wanted, with the amenities that I needed, with the number of bedrooms, with the number of bathrooms, okay? So let's say, for instance, that's $300,000, okay? So again, and now again, mine was a little bit different because I'm VA. I used a VA loan. So my loan was already 100%, but I still had to qualify. I still had to make my thing fit into this qualifying mortgage situation. Okay, so what you're going to need to do is look at your gross revenue before you file your taxes for 2 years. Each year, you need to look at your gross revenue. And for some of you, you need not write off anything, because you may need every dime of that 80,000 or that 50,000 or whatever your income is. You may need every dime of that in order to qualify for the house that you want. Yes, it means you're going to pay taxes on it, but hey, this is just what you're going to have to do if you want to get this mortgage right here, where you got the good interest rate, things like that. But what you're going to need to do is you're going to need to take your business income, all the revenue, all the business income that you had, add that all up. If you do hair, if whatever you do, you need to look at your gross receipts from what you did the previous year. Okay? You need to add all that up. Then you need to add up your expenses. Add up your expenses, your booth rent, your products that you bought, the hair that you bought, anything that was an expense. For those of you who may be, Uber or Lyft or whatever, you're gonna need to write off you would want to write off your mileage and your maintenance and your oil changes and your gas and all that good stuff. You're gonna need to add up your expenses. So over here you got your revenue. Over here, you got your expenses. This is what you need to think about before you file that tax return. Because let's say, again, I had 80,000 in revenue and I got 60,000 in expenses. Okay, cool. I'm going to write off 60,000. So that's going to leave my adjusted gross income as only $20,000. I don't know where you buy no house at. Not nowhere in the United States. I don't know where you buying a house at where you're only showing $20,000 worth of income. This is where you need to stop and think before you write all this off. Is it fair? No, I've told y'all that before. It doesn't make sense. But especially now, post-pandemic economy, we have so many more people who are self-employed or in some type of self-employment. You may still have a job and you're doing Uber or Lyft or something on the side. Then you need to really stop and look and see, do I really need to write off all of my expenses? Because if you write off all your expenses, you will not have any income. Your adjusted gross income is going to be a negative and you will not get a house, because on paper you're broke. On paper you're poor. On paper you have no income. So no, you will not be able to qualify for a mortgage. Okay, so just as I was saying for the W-2 people, once you have your adjusted gross income, and this is line 11, this is line 11 on the 1040 form. Once you have your adjusted gross income, that's the number you're going to work with. See, once you go on and file the rest of you do the rest of your tax return, it's all about, are you taking standard deduction? Are you itemizing your deductions? All that. That doesn't matter. It does not matter. What matters is that adjusted gross income. So then what you need to do is take that adjusted gross income, let's say it's $50,000, okay? And then you need to divide that by 12. That's going to give you your monthly income. That's how you calculate your monthly income. Okay, so we're gonna take that 50,000 and let's say you end up with $4,000 roughly. You end up with $4,000 a month. This is the number that the mortgage company is going to use to calculate your debt to income. So again, if you're doing an FHA loan, your front end ratio cannot be any more normally than 30%. It's 29 to 30%. So on 30% on that $4,000 is $1,200. Am I doing my math? I think I'm doing my math right. So your monthly mortgage payment can be no more than $1,200, and that's PITI, principal, interest, taxes and income, taxes and insurance, plus your mortgage insurance, because you will have mortgage insurance on an FHA loan if you're putting down less than 20%. Okay, so you already know, if I claim $50,000 is my adjusted gross income, which gives me roughly $4,000 a month income. So 30% of that is $1,200. So I know that my mortgage payment cannot go over $1,200. This is where I would stop right here and just make sure that that's going to work. You need to go to a mortgage calculator. Again, I will link the mortgage calculator on my website. I'll link it down below. If the house you're looking at, when you go and you calculate that payment, and that $1,200 ain't even coming close to what you're trying to buy, or it's not coming close to the type of house that you need for your family, in the location that you need for your family, then you need to stop and maybe redo your calculations on your adjusted gross income. Because if you need more than that $1,200 front end ratio will allow on FHA, you got a problem. You need to go back and redo your numbers. Redo it till it works. Now, I'm not going to say it ain't going to hurt, because let me tell you something. When you go on up on that adjusted gross income, that tax bill go right on up with it. Goes right on up with it. I'm sorry. It sucks, but that's the truth. Okay? So once you look at your front end ratio, maybe that $1,200 or whatever that number is works for you. Okay, cool. Now we got to look at the back end ratio. We need to look at the back end ratio. You need to take the minimum payment on all your debt. That's revolving debt like credit cards, store cards, gas cards, any revolving credit, any installment loans like your car note, like a personal loan, any other type of loan that you have. Plus, you need to look at that minimum payment on those student loans. Again, I'll link my last video about the student loan changes that are taking effect in August. But you're going to need to, again, you got to do the work. You got to do the work. You got to do the work before you even file your taxes. So for those of my borrowers, y'all have the student loans like I do. You need to go in there and see how that payment is going to be calculated now, especially if you're going on FHA. You need to see how is that payment going to be calculated. If it's showing a zero balance, then it's going to be 0.5% of your total student loan balance. If you're on one of the repayment plans, is the plan amount that you're supposed to pay each month, is it reporting on your credit report? Again, go to annualcreditreport.com, see how your stuff is reporting. Do this homework now. Don't waste time. Look, I saw in another group I'm in, and this girl, and she had put on, I don't know if the guy was her boyfriend or what, and she said, yeah, he got bad credit, but I put him on for the income. And they got turned down. And then she's like, well, should I just go to another lender? No, you should do your homework first. Get your numbers right. Don't rely on somebody else to get those numbers right for you. So once you take those minimum payments on all your debt, you're going to want to calculate your back end ratio on your debt to income. So if the total of all of your debts plus this new house payment and everything, if it's over 41 to 42% of your income, you're not reporting enough income again. You may want to adjust it, because FHA is not going to let you go but at the most 45% on the back end unless you have very, very strong credit. I mean, you're looking at a 740 or higher credit score, and you got a lot of compensating factors. But for a lot of us who are newly self-employed, let's say before 20 you were W-2'd, and now since 20 you're self-employed or whatever, you got to have a lot of other compensating factors. So you're going to want to make sure that you have enough income where your debt to income works. And remember also, if you're going to have a tax liability, meaning you're going to owe taxes once you file your taxes because you're not writing everything off, include that liability in your debt to income ratio. Include it in with those other installment loans, base payment. You got to include that, because now that has become another liability, and that debt has to be included in your DTI. I know when it comes to calculating your income when you're self-employed, it is not easy. It is not an easy pill to swallow, but you have to do it in order to qualify. That's what you have to do. And let me tell you this, once you get in the house, the hard part is getting in. The hard part is getting approved, finding the house, not getting outbid, and actually closing on the house. Actually closing. I'm going to do another video where I need to talk about what we need to look for in our loan originators, because again, anybody can pre-qualify you. And a lot of loan officers can get you a pre-approval. But can they get you to closing? That's a whole nother ball of wax right there. But we're not going to go over that right now. But once you get in that house, and I'm expecting phone calls, pictures, videos, invites to the housewarming party. That's right. I'm petty like that. I expect the invite. Once you get in it and you make that payment on time for at least 12 months. You will be able to refinance. And let me tell you something. A lot of the refinances, if you're doing a straight rate and term, like you're not taking no money out, they don't even care. You could be self-employed. You could have went back to work. You could have been doing whatever it is you're doing. And then it's so much easier to qualify, because a lot of times, especially on your FHA and your VAs, when you're doing just a rate and term, and your USDAs, only thing they want to know is that you paid the payment on time for the past 12 months. And then they'll refinance you. It's a walk in the park. This is the hard part. Obtaining a mortgage is the hard part. Maintaining it, to me, is much easier. But just don't. I know you're going to get tired. You're going to get frustrated. You're going to get pissed off. And the system is not fair. Trust me, I know this. It is not fair. But believe me, if you can get to closing and become a homeowner, get you a mortgage, after that it's so much easier, because when you get ready to refinance again, they're not going to ask you hardly anything about your income, because you have a proven track record of paying your mortgage. And then as your values go up and you grow some equity, there's other opportunities you're going to have to cash out and maybe take some money out and do some different things with. But you got to get over this first hump first. That's what you got to do. Just keep your eye on the prize and know that you got to get over this first hump, and then everything comes together. Again, my name is Rhonda Burgess, and I'm a real estate broker and mortgage underwriter here in the Nashville, Tennessee area. If you know this video can help someone, please share the video. I would greatly appreciate it. And if it's your first time on my seeing any of my videos, please consider subscribing to the channel. And if there's a certain topic that you would like for me to cover, please leave a comment down in the down below, and I will certainly, I'll reply to you, and I will certainly do my best to get that video out. Again, if you need any help with buying or selling a home here in the Nashville, Tennessee area, my number is 615-554-0832. Thank you, and as always, have a blessed day.